Chapter 2, the conceptual framework. In this class, we're going to get theoretical. That is, we're going to start at ground level and lay the foundation of the accounting system in place in the United States today. Last class, we talked in big picture about what the financial statements look like and why we have them, and today we'll look a bit more of the nitty-gritty that got us there. Included in this is a discussion about what the goals of financial reporting are, which is important because they're not likely to jive with your preconceived notions as to what the goals are. So on the top of your notes for Chapter 2 are 3 statements that I lifted from the FASB website. These come from one of the statements of accounting concepts, so they basically tell us why we are here. Our primary goal is to provide information for decisions. So it's not just any information we can think of, it's decision-useful information. What this means is that whenever we're looking at financial statement information, and we will look at a balance sheet and income statement later today, there is an awful lot of detail that we provide people, and whenever we see something like that, it's always for a reason. If we see a particular subtotal or a particular piece of information highlighted and pulled aside from other information, it's because the industry has decided that little nugget is important enough to bring to the user's attention. So what is it that we're looking for? Certainly, we're looking for cash flows. We'll be spending a lot of time in this class looking at how we account for things, and how that is different than recording the flow in and flow out of cash from the business. Ultimately, though, what we need to be able to do is to predict the cash generation ability of the firm, because the firm needs cash to pay bills and pay dividends and to grow. We're also going to provide information about the assets and liabilities of the firm. There's our balance sheet, and also the transaction that caused those assets to go up or down. Why did our receivables go up? Why did our payables go up? Those changes can be traced to the income statement through our transactions with other parties. Sales to clients, expenses for wages and products and utilities, and the like. Those are big picture what our goals are. Improving decision making by providing cash flow information, balance sheet information, and income statement information. Now, how do we get there? Well, accounting has 3 primary characteristics. That is, for information to be decision useful, it needs to meet these 3 criteria. First, the accounting information needs to be understandable. And this is a fantastic thing to talk about right up front, because when we say understandable, we don't mean understandable to just anyone. We saw this last class. Accounting information is meant to be understandable to people who know the rules of the game. That is, we want financial statements to be understandable to the reasonably informed user, not your average Joe on the street. We assume that if you're looking at financial statement information, you know to look in the footnotes for the detail that puts the balance sheet and income statement into context. We aren't going to do your financial analysis for you. We're not going to tell you what the value of the firm is. We're just going to provide you with the raw data you need to make those judgments on your own. It needs to be relevant information. We won't include extra data that isn't going to be useful to anyone. And we have to be timely in our presentation of data as well. This means that if we're a publicly traded company, we have to have our annual report filed within 60 days of the end of our fiscal year. There is tension here because we want to provide relevant information, but the information needs to be reliable as well. And the tension is that it's very difficult to provide both at the same time. In fact, it's very rare that we will be able to do so in our financial statements. Let's say you want to buy a company. What would be the most relevant piece of information to help you set a price for that company? Its true value, of course. With that in hand, you'd know exactly what to offer. So there is completely relevant information, but does it pass the reliability test? Well, where did that number come from? It came from someone's estimate. And if you asked another firm valuation person, they would probably come up with a different number. Probably something close, but not exactly the same. And a third, yet another number, and so on. So that number isn't a reliable number that we can put confidence in. What makes information reliable? Well, it needs to be objective. If another person looked at the same data, they would come up with the same number. It needs to be independently verifiable. Some third party needs to be able to look at the information and say, yeah, I buy that. And who's the third party? Typically our auditor. That's their job, to give an independent assessment of whether the numbers pass the sniff test. And, in theory, it's meant to be neutral, neither positively nor negatively biased. The reality is that accounting is not neutral, but that's the sort of goal that we're supposed to strive towards. So with those characteristics in mind, we need to make a series of assumptions about how we're going to look at the data. How many economists does it take to change a light bulb? Just one to assume it's been changed. No, not that sort of assumption. Assumptions that allow us to put the data into a usable format. The way that I like to think of this is that we, the accountants, are measuring firm performance, and we can express it with the following equation. We assign V the value of the firm at any particular time. And the firm's performance, P, is the change in value. There, we've got two balance sheets, one right here and one right here, and we've got our income statement right here. And those are the balance sheets. So our first question is that if the balance sheet is the assets and liabilities of the firm, well, what exactly is the firm? Now, this really isn't a tricky concept, particularly if we think about corporations. Then it's easy to figure out who is the firm. When we go out to work for ourselves as a sole proprietor or a partnership, though, it's important to recognize that the firm is separate from its owners. Because if I want to know whether or not my business is successful, I don't want my personal activities, like going to the slots or something, to pollute the information. So our firm is a separate entity from the owner. Our second assumption is in two parts. Some people call it the stable dollar assumption. Some people call it the monetary unit assumption. I think that they're both applicable. Certainly the monetary unit part is that we're going to denominate everything in US dollars. We're in the United States, so we're going to use our currency. If we can't denominate something in dollars, it doesn't belong in the financial statements. And this makes sense because we need to be able to calculate totals. And we can't add dollars plus trees or something like that. That just wouldn't work. The trickier part to this is the stable dollar part. We ignore inflation for GAAP. Everything is expressed in constant dollars. Now, this isn't something you can do everywhere. Zimbabwe, for instance, had, according to one estimate, annual inflation of 89.76 trillion%. But in the United States, inflation is considered low enough that the benefit we might get from making inflation adjustments to our financial statements wouldn't be worth the effort it would take to actually implement it. So if we spend money today, and we spend money a year from now, we're going to keep them on equal footing, even though we may know that purchasing power has eroded. It's worth remembering, though, that even with a 2 or 3% inflation, we can experience some significant funkiness over longer horizons. Let's say we buy a piece of land for $10,000 in 1950. If we have 2% inflation, that land would be worth almost $33,000 today. Now, I had a professor who liked to denominate things in Big Macs, which, if you think about it, really is a brilliant concept. How much is a Big Mac today? Well, let's say it's $2 today because it makes the math easy. And if we backed out inflation, we could impute that it would have cost us about 61 cents back in 1950. Is that really how much it cost? Probably not, but just humor me. So anyway, let's think about this land in the context of Big Macs. If we bought the Big Macs with that $10,000 way back when, what would we have gotten? Well, most likely a quadruple bypass, because that would have been about 16,500 of those bad boys. Nom, 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 nom. But we didn't. We bought that piece of land and sat on it until 2010 when we decided to sell it for the $33,000. And when we got the money, we thought to ourselves, we're pretty hungry. Let's go to Mickey D's. How many Big Macs can we get with that money? Still about 16,500. Nom, nom, nom. Which, while a buttload of Big Macs, isn't really any different than what we could have gotten back then. From an economic standpoint, even though we have more cash, we have constant buying power. Now, how does that fit into our accounting world? Well, we bought the land for $10,000 back in 1950 and sold it in 2010 for $33,000. Our accounting system doesn't recognize inflation, which means when we make that sale, what do we call that $23,000 difference? A gain. So our accounting system, because of this stable dollar assumption, tells us that we have created value even though we haven't. While we have learned to live with it, it is certainly something that should be kept in the back of our heads, especially should inflation here ever spike upwards. The next assumption is the fiscal period assumption. How long is the period between T0 and T1? I argue that we could have a T0 and a T1 that if we pick them correctly, we can measure P with absolute precision. We'll know exactly what the value created of the firm was. What are these 2 points in time? If we say here is T0, and here is T is equal to 1. What are those 2 points? Beginning and ending of a month? No. Beginning and ending of a year? No, still not long enough. The only way that we can be 100% sure about what P is if we set T0 and T1 equal to the birth and death of a firm. Think about it. We know exactly how much money we put in. We know how much money we took out. But how useful is that? It's not. Remember timeliness? If I have to wait until the company shuts down for you to tell me how well it's done, that's completely useless to me. First of all, it's too late for me to make any real decisions. And if you think about some of these companies that have been around for a long time, how many people have died since Wells Fargo or Sears were formed? We can't wait that long. So what have we done? We've taken 12 months and we've said, that's going to be our fiscal year. And so we have broken the life of the firm up like that. Why did we take 12 months as our time period? Because by complete happenstance, that's how long it takes for the Earth to travel around the sun. Say we were living on Mars. First of all, we'd be dead since there's nothing to breathe. But we'd also have different measurement periods. The Martian year and the Earth year are different. So there's nothing magical about our choice of reporting period. Monthly, quarterly, annual. Those are all purely arbitrary. We need relatively short time periods, though, so those work for us. Again, it's worth keeping in mind that this assumption can cause some trouble. Firms don't shut down on December 31st and start back up on January 1st. They don't live in compact 12-month intervals. Companies are fluid, and their contracts and transactions are fluid and extend beyond what we typically think of as traditional reporting periods. Say, for instance, we sign a contract here. It's December 12th, and we just signed a contract to be the sole provider of stuff to China. And that's a lot of stuff. The ramifications of that decision are going to extend well beyond the 12/31 fiscal year cutoff. So don't ascribe anything magical to the concept of a 12-month year. When you're running your own business, you need to constantly be looking forward, not just to the end of the current period, but into the next period and the period after as well. Our last assumption is the going concern assumption. We assume that the business will continue to operate indefinitely. And this is very important to us when we think about the values of our assets as we report them on the balance sheet. Say I go and buy myself a truck and drive it off the lot and I tool around town with it a bit and I put a couple hundred miles on it. What's that truck worth now? I paid 30 grand for it. What could I sell it for now? Not quite what I paid for it, because it's now a used truck. Why would someone pay me 30 for a truck with a couple hundred miles on it when they could pay 30 for one that's brand spanking new from the dealer? So the truck has lost value. The going concern assumption says that we don't care about that loss of value. It just doesn't matter to us. Why? Because we're not planning on selling it. Its liquidation value is of no importance to us. We bought the truck to use in our business, and the value we get out of that truck from delivering things in it, or doing whatever it is that we do with it, exceeds its liquidation value. Now, that isn't always going to be the case. When we have a company in severe financial distress, the auditor must make a determination and will sometimes include a paragraph in their audit report that says the financial statements are based on the business being a going concern, and that there is serious question as to whether or not the business will be able to continue. Okay, so we've got our characteristics, what we want our information to look like. We've got our assumptions, the framework under which it's possible to have those characteristics. Now we're going to start to set out the rules, and those are our basic principles. The historic cost principle we've actually already touched on a little bit. If you remember, in the context of the stable dollar assumption, implicit in that discussion was that the land we bought for $10,000 stayed on the books at $10,000 until we sold it. And that's what the historical cost principle is. In most cases, we will keep our assets and liabilities on the books at their historical costs. That is, whatever the original value we assigned the item will remain the value on the item of the books until we dispose of it. We will ignore the fair market value in most cases. This comes back to the tension between relevance and reliability. Fair values on our balance sheet would be very relevant information for financial statement users. In most cases, though, it's unreliable. For instance, you are viewing this class on a computer. Perhaps you know what you paid for it when it was new. But as technology changes and the computer gets some wear and tear on it, the true value of your computer is a difficult number to come up with. Another example would be what I like to call the My Indiana House example. And the fact that there's a little sad face at the end should tell you what sort of story this is. Here's a timeline for my house. Back in 1998, I moved to Indiana and bought my house for $115,500. They accepted our first offer, so we obviously paid too much. But what can you do? Anyway, we moved in 1998, and 6 years later, we were ready to move to Maine, so we put our house on the market. Now, of course, one of our friends was a real estate agent who said she would be happy to list our house, and being unable to say no, we said, okay. Oops. So, we listed it at $142,900, which I thought was a little bit high, but what our friend assured us was it was competitively priced. Competitively priced for our neighborhood, which in real estate agent speech means I get paid on commission, so let's price it high and roll the dice. So we put the house on the market in July, and time starts to pass, and time starts to pass, and nobody comes to look at the house, and the price starts to go down. So December comes around, and oh no! A pipe bursts. This is, of course, a vacant house since we moved to Maine. It was the pipe that takes the water to the refrigerator. We didn't actually have an ice maker in our fridge, but there was a pipe there anyway, and it burst and it flooded the first floor. So we had to dry out the carpets and replace the padding and all that stuff, and the price continues to go down. Down goes the price. Down goes the price. So in January, someone comes to look at our house, and they leave the door open. Where's my door? There's the door. Okay, and there's the handle, the doorknob on the door. Okay. Now, of course, out in Indiana, everything is on natural gas, which isn't like propane out here. There's a pipe, and all the gas we want to use, they'll keep on piping out. You know that global warming thing? Yeah, that was my fault. Sorry about that. And the price continues to go down. Spring of '05 comes along, and oh no! Another leak. And this leak isn't one we found out because someone's walked in and stepped in a puddle. Actually, it's kind of funny. I was opening my mail here in Maine, and I got a letter from the water company in which they said they were going to send us a bill. Now, I thought this was kind of odd because usually when people send you a bill, they just do so. They don't tell you they're about to do it, and then do it. So anyway, I forgot about it, and then the bill came, and I opened it up, and then I understood. In a single month, in a vacant house, we managed to use $206,000 gallons of water. Holy shit. You could keep an entire African village in that water for a year with that. So I called the water company up and I said, I just got this bill. And they said, yep, you sure did. We even sent you a letter about it. And I said, surely there's a mistake. It must have been a misread meter or something. And they said, yeah, we thought so too. So we sent someone out there to look. And no, that's right. You got a leak somewhere on your side of the meter, which means it's your problem. Don't you wish you'd gotten that pipe insurance? And I said, okay, well, did you turn off the water? And then there was silence. No, sir. Well, how about you go send someone out there to do that for us, Tiger? It turns out that it was a toilet that was messed up somehow, and the water was just flowing right on through. So in addition to the water bill and the sewer bill, which was tied to the water meter, we had to hire a plumber to fix the toilet. Now, a little later on in the spring, this being Indiana and all, what happens? Tornado! The house was luckily undamaged, but we had this gorgeous pear tree out in the front yard, and the poor thing got mowed right over. And it left this big old jagged stump in the ground, and we had to get it ground down, because if someone had been playing on our yard and tripped and fell and broken something or got impaled or something, like in that Flash Gordon movie where Ming the Merciless gets impaled by the spaceship at the end, we would have been in a world of shit. And still the price continues to drop. At some point throughout all this, we got an email from our real estate agent that another agent had left her a message saying that there was something left in one of the toilets. Yes, that kind of something. You know, I found that really quite ironic. I mean, we just used 206,000 gallons of water in our toilet. We certainly could have spared him a flush. So here we are in August 2005, over a year after we finally listed our house, and we finally find a buyer who doesn't want us to be the ones to loan them the money. Will you self-finance? No, screw you. If the bank's not going to trust you, I'm not sure going to. And the final price it got settled on was $122,900. Now we know that the bank, before it loans you the money, requires an appraisal on the house to make sure that it's not lending you more than the house is worth. And our appraisal comes in at $131,000. Which of course suggests why no one wanted to buy our house at the oh so competitively priced amount of $142,900. So $122,900 was the price, and we had to get them a new dishwasher. We had to replace all the carpeting on the first floor. We had to hire a licensed HVAC specialist to explain to them that the further away you get from the air compressor, the weaker the airflow gets, since that sort of science appeared to be beyond the buyer. And we had to get a licensed electrician to screw in an electrical faceplate outside. And when you put all that together and you factor in the 7% commission for that fantastic real estate service, if you do the math, you realize that I'm the only person in the United States of America who owned a house between 1998 and 2005 and actually lost money on it. And it's not to say that we're at all bitter about it, but when my wife was ordering the dishwasher, the guy asked, "Do you have a model in mind, ma'am?" And she said, "The loudest one you've got." And everything in the kitchen is white. So she got the dishwasher in eggshell. Meaner. Now, if you recall, we were actually talking about something of substance before this little diversion. Asset valuation. Let's go back to December 2004, when Daveco would have had to present financial statements. What value could we assign this on the balance sheet? We'd gotten a licensed real estate professional who told us 142.9 was the magic number. Of course, by the time 12/31 had rolled around, we'd dropped the price down to the upper 130s. Meanwhile, we had another real estate professional, the appraiser, give us a value of $131,000. And ultimately, what is the real value of the asset? What I was willing to let it go for, $122,900. So while having an accurate value for the house at year end would have been hugely useful to everyone, it was completely unreliable without the context of an actual transaction between buyer and seller. So what do? We leave it on the books at the original cost of $115,500. Not because that piece of information is particularly relevant, but because it's reliable. I have a purchase and sale agreement that shows exactly how much we paid, and that's the number we're sticking with. Now, this isn't a universal principle. In fact, there's a particular type of asset for which we can get down to the penny valuation with complete reliability. Think about when you buy a stock in another company. We buy some shares of Coca-Cola. If we want to know what the value of those shares of stock were on December 31st, what do we need to do? We just get the Wall Street Journal from January 1st and it'll tell us. For those types of investments, we'll go ahead and report them at fair value because that price we see in the journal is an actual transaction between two individuals, so has pinpoint accuracy and is completely reliable. The second principle is full disclosure. What this means is that we should provide all the information that would make a difference to a decision maker. This is, of course, all within reason. We're not going to provide trade secrets. We're not going to talk about strategy. If we're a public company, part of our filing is the management discussion and analysis, which among other things does provide an executive summary of our plans for the future, but it doesn't need to be very specific. But let's say we're BP and we just had one of our deep sea rigs explode. The next set of financial statements is going to provide an awful lot of information about what it's going to mean for the company in terms of cleanup costs, lawsuit costs, potential effects on future drilling opportunities, or the lack thereof, and the like. Third is revenue recognition. When do we get to call something a sale and put it on the income statement? This is a hugely important concept for us to get our minds around as quickly as possible in this class, because our decision to recognize revenue has almost nothing to do with the receipt of cash. We recognize revenue when the work is done. As soon as we've done our share of the job, we can call it revenue, even though we haven't been paid yet. And this is important because in much of the business world, unless you're talking about retail purchases, almost no business is done on a cash basis. For instance, my wife is a doctor. They provide services to patients and then submit the bills to the insurance companies. Depending on which insurance company you're talking about, it might take months to see the cash. And God forbid you're dealing with MaineCare. MaineCare recently reimbursed Eastern Maine Medical Center for services they provided to patients 3 years ago. If we waited 3 years to tell you about the work that we did, that certainly wouldn't fit the bill for timely information, would it? The one catch to this is that we do need to expect that the payment is going to happen. It doesn't have to happen right away, but so long as we have done the work and expect that the cash will come in the door at some point in the future, we get to call revenue earned. This does, however, effectively put a damper on the unreasonable revenue figures. Returning to the example of the hospital, when they provide a service to a patient with insurance, they know how much they're going to collect. They might say that the procedure is worth $100, but if they know that MaineCare will only reimburse $40 for it, all they get to call revenue is the $40 they expect to receive in cash. The upshot to this is that the revenue we recognize on the income statement could happen before or after when the cash changes hands, not just at the point of sale when the customer gives us cash. We'll spend a goodly amount of time exploring this in future classes. The corollary to go along with revenue recognition is expense recognition and brings us to the matching principle. As I said, we recognize revenues when we've earned them and cash collection is likely. On the other side of the equation, we recognize expenses to match with the revenues they generated. Think of the income statement. We've just recognized revenues because we provided goods or services to our customer. For us to provide a complete picture of what we did this past year, we need to figure out all the costs we incurred to generate that revenue. Only then can we point to the bottom line that says net income and have some sense as to what the firm actually did. This again means we're divorcing the income statement from cash in, cash out. If we used electricity in December, the expense belongs in December when we did the work, not in January when we get the bill, or in February when we write the check. We will be recognizing expenses sometimes before we've billed, or we might even recognize expenses after we've written the check. Again, we'll explore this concept in much greater detail later. This next slide provides a nice picture that illustrates the matching process. Let's say we spend some money today. Let's buy some inventory. When do we recognize the revenue associated with that purchase? When we make the sale, right? So let's say we buy 2 pieces of inventory. Here's one piece of inventory, and here's the other piece of inventory. And then we sell one. The revenue for one is recognized this year when we make the sale, and the expense shows up in the current period on the income statement as cost of goods sold. The other piece, however, hasn't been sold yet. We've still spent the money on it, but the revenue won't be recognized until we sell it next year. So what do? We call it an asset and stick it on our balance sheet until next year. We have capitalized that cost as an asset, and it will stay an asset until we finally generate the revenue. And then we'll recognize that as cost of goods sold. Now, there are always exceptions, and here are ours. First, as in all things, we need to be aware of the costs required to yield a particular benefit. The same holds true for accounting information. There are refinements we could make, or accounting methods we could choose that would possibly improve the usefulness of our financial statements. However, when we look at how much it costs to generate that information, we decide it's not worth it. And this decision is made on a case-by-case basis, either by firm or by industry or whatever. An example of this would be the value of our investment portfolio. We already know that we can get the market value of those stocks on a daily basis. The question is, under what circumstances is that worth the effort? If I'm Daveco and I've got a small chunk of spare cash parked in the stock market as part of my cash management strategy, if those stocks go up or down by 1% or 2% in a day, it's not going to have any real impact on financial decision makers. I could, if I wanted to, provide a news release every day, but what would the point be? Contrast that with the mutual fund industry. When people buy in or cash out of a mutual fund, the transactions are always done at the closing asset value on the day the trade was initiated. What this means is that every single day, as the stocks within that mutual fund go up or down, people will be buying and selling at different amounts. So it's critical that we spend the time to actually calculate and report those values. Second is materiality. We are only going to report the information that makes a difference to financial statement users. Again, this is a sliding scale based on firm size. If you're General Electric, $50,000 doesn't really make much difference to a decision maker. If you're Orono House of Pizza, on the other hand, $50,000 that's a pretty big deal. So we aren't going to have the same level of disclosure for those two companies. $50,000 is immaterial to GE. It's hugely material to House of Pizza. The last exception is conservatism. Like I said at the beginning, while we would like our accounting to be neutral, it really isn't. And while this typically makes people chuckle when I say so, we're actually conservative. What do I mean by conservative? Well, when in doubt, we should be pessimistic. What this means is that we're going to overstate liabilities and expenses when there's a judgment to be made. Say we're estimating future warranty costs. We'll tend to aim high instead of aim low. Similarly, for assets and gains, we will tend to understate or defer them completely. If we're sued, have lost, and are going to appeal, we book the loss immediately. If we're the ones doing the lawsuit and they appeal, we don't book the gain until we get the check. Why do we do this? A very simple reason. What if we are optimistic and we are wrong? Say we tell people things are good, and then they buy our stock for 50, and then we say, oops, we were wrong, and the stock price drops to 30. What do they say to us? That's fraud. You should have known better, and you should have told us sooner. I bought 1,000 shares, and I want my $20,000 back. And they sue. The firm, the board, the executives, the auditors, everyone gets sued. And that's no fun. But what if we're pessimistic and we turn out to be wrong? People buy our stock at 30, and then it goes up to 50. And what do they say? Yay, you're heroes, I love you! So as a defense mechanism, US GAAP has evolved into something that is absolutely not neutral. It's pessimistic. Okay, so now that we've got our framework in place, let's talk about some nuts and bolts. Everything we do in accounting ultimately boils down to 6-ish types of accounts. The trick, of course, is knowing which accounts a given transaction affects. But the truth is, once we understand what these things are, it really isn't that hard to get things into these buckets. Assets are defined as future economic benefits resulting from a past transaction. A simpler way of looking at it is what we own, or stuff, but it really does go beyond that. Let's say we prepay an insurance policy for the next 12 months. Although it's not really stuff, it is a future benefit. Namely, we have 12 months of insurance coverage. So when we write that check, we'll call it an asset until we actually start using it up. Liabilities are future economic sacrifices resulting from a past transaction, or what we owe. And again, this decision is broader than simply owing Bangor Hydro for the electric bill. Let's say one of our customers prepays us for 12 months service. When we receive that check, we haven't done any work yet. And in fact, we owe them 12 months worth of work. So that receipt of cash, while being an asset, also results in a liability. We have an obligation to another party. And of course, the third type of account is equity. And this is the marker for what the owners of the firm have tied up within it. Recalling our fundamental accounting equation, assets equals liabilities plus owner's equity, we remember that this is what's left of our stuff after we finish paying off all our obligations to non-owners. The next three accounts are flow accounts. First is a dividend, which represents a payment to owners out of firm equity, basically giving them a little bit of their money back. If you've ever owned shares of stock, you've probably received a dividend check for some small amount of money. This is simply a way of giving the owners a bit of what the firm has generated in profits. Revenues are what we earn for providing a good or service. This includes selling a good, in which case it's sales revenue, providing a service, in which case it's service revenue, or even loaning someone money, that's interest revenue. As I said earlier, expenses are the costs of generating revenues. These don't necessarily need to be immediate cash payments. There are also gains and losses, which are similar enough to revenues and expenses that I just throw them in there with an asterisk. With these 6 account types, we have everything we need to create all of our financial statements. Let's take a deeper look at a couple of the financial statements, beginning with the balance sheet. Of course, we know that the balance sheet maintains our fundamental accounting equation, assets equals liabilities plus owner's equity. But within that framework, there is additional classification. Looking at the asset side, the assets are listed in order of liquidity. What's liquidity? It's the speed with which an asset can be converted into cash. And why do we care about liquidity? Solvency, which is our ability to pay bills as they come due. Remember that we need cash to pay our bills, and if we aren't able to pay our bills, we go into bankruptcy and the shareholders lose boatloads of money. So what we have done is break the assets and liabilities into groupings based on when we think the cash flow is going to happen. This will allow users to more easily come to a conclusion regarding the near-term solvency of the firm. We have broken our assets and the liabilities into what we call current and non-current. What is a current asset? An asset that we will convert to cash within 1 year or 1 operating cycle, whichever is longer. What is a current liability? A liability we will need to be paying off within 1 year or 1 operating cycle, whichever is longer. Now, what is an operating cycle? It's the process of going from cash to inventory to receivable to cash. Certain industries, defense contractors perhaps, and other aerospace companies likely take longer to produce their product and bring it to market. Boeing makes airplanes. Bath Iron Works makes destroyers. And so for those particular industries, we extend the current non-current distinction beyond the 12-month window. So our balance sheet is really set up really nicely for us to make solvency decisions. That's why we make that distinction. Now let's take a look at a real balance sheet that I pulled from the Coca-Cola annual report. Over the next several pages of your notes, you'll have quite a bit of my own writing about what the various items are, and your book also goes into a discussion of them as well. I don't need to read those to you now. Rather, we're going to look at these statements I've reproduced and see what we can see about how they're put together. What do we see on this balance sheet? Well, first, we see that there's 2 years of data here. We want to be able to compare where we are this year with where we were last year, so we lay it right out for you. We see that this is for Coca-Cola Company and subsidiaries. What this means is that we've taken all the little sub-companies that Coke owns and rolled them up into what we call a consolidated balance sheet. If you see, they've got about $2.4 billion of cash on their balance sheet right now. But that doesn't mean that Coke has that much sitting in an account down at Bank of America. What it means is that Coca-Cola, through its subsidiary companies, controls $2.4 billion in cash, both directly as part of the cash that they own, and indirectly the cash held by the companies they control. The reason we do this is, let's say that Coca-Cola owns Dave's Bottling Company. Even though they are 2 legally separate entities, from an economic perspective, they are acting under a single corporate strategy. And so the accountants treat them as one big happy company. This holds true for all of the other assets and liabilities on the balance sheet, as well as the revenues and expenses on the income statement. The consolidation process is relatively complex. I actually teach an entire semester's course on it, BUA 507, so we'll leave it at that. Just getting an understanding of what it means to report consolidated financial statements is good enough. This particular set of financial statements has a December 31st year end. We don't have to use December 31st as our fiscal year end, and in many cases, it makes sense not to. I had a client whose fiscal year end was the last day of February, which means that every fourth year, the fiscal year ended on a different date. Fiscal year is completely arbitrary so long as it is consistent from year to year. Walmart and other retail outlets won't use December 31st because they have all those holiday sales floating around out there. And because much of what we get from the great Aunt Millies of our families is crap. So they know that a bunch of the stuff they sold in December will be returned in January. So on December 31st, they have no clue whatsoever what the results of their holiday sales will ultimately turn out to be. The university has a June 30 year end because summer is a relatively dead time. There aren't a ton of classes, there's not a lot of student activity. This makes a perfect time to wrap up our accounting for the year. Okay, so what's next? We see assets on the top and we see liabilities and equity on the bottom. Sometimes you'll see the assets on the left and the liabilities and equity on the right. Either way works. And so here we see our current assets. The assets we expect to be converted into cash in 1 year. The first one on the list is, of course, cash and cash equivalents, which are very short-term maturity debt instruments. They may as well be cash considering how quickly they mature. And that's on top because, well, how long does it take to convert cash into cash? That's stupid, Dave. So let's move on down the line. How quickly can we turn stocks into cash? Well, we call our broker, we tell them to sell, they find a buyer, and the money is our account by perhaps the next day. So, marketable securities comes next. Accounts receivables, what our customers owe us for the stuff that we've sold them. How long does it take for us to get that money? If we're not dealing with main care, 30 days, 60 days, 90 days, not terribly long. We typically live in a 30-day world. We get our bill from the electric company and they tell us to pay within 30 days. You'll note that this is less allowances of 63 and 72 respectively. Here we see conservatism and full disclosure showing up. We know that not everyone is going to pay us when we extend credit to them. That 63 and 72 are estimates of how much of our receivables in 2006 and 2005 respectively are going to ultimately get written off as uncollectible. So our balance sheet isn't reporting how much we are owed, but rather how much we think we're going to actually collect in cash. Why? Again, it helps us determine solvency. We'll come back to this in Chapter 4 when we look at receivables in more depth. Inventories. Inventories next. How do we get cash out of inventory? Well, we sell it. So first we have to find ourselves a buyer, and then it becomes a receivable. And then we wait 30, 60, 90 days for the receivable to get turned into cash. So inventory is a little less liquid than receivables. Lastly, we have a catch-all for our prepaids and other assets. Remember that prepaid insurance when we were talking about assets just up above? That's going to go down in here. It is a future economic benefit. We're not going to be getting cash out of it, though. We're going to stick it here in this prepaid expense and other assets at the bottom of our current assets. Coca-Cola has an interesting second section to its assets, these investments right here. Now, we've already seen that they have marketable securities up here in the current asset section, and those are the stocks and bonds they bought with extra cash to make a little extra money. These are different, though. Sometimes we will buy shares of another company, not for the sake of capital gains or dividends, but from a more strategic direction. Perhaps we buy those shares of stock to get the rights associated with them, specifically voting rights. Each share of stock gets one vote for matters of importance, such as electing board of directors and the like. The board of directors' job is to hire and fire management, so the owners of the firm, the shareholders, have an indirect influence on the way the company is managed. If enough shareholders don't like the way the company is being run, they tell the board of directors to hire new management. So it might make sense for us to buy 30 or 40% of a company, not enough to own it outright, but enough so that I have the ability to influence firm policies. Look at the names of these investments. Coca-Cola Enterprises, that's their US bottler. Coca-Cola Hellenic Bottling Company. Other, principally bottling companies. Those others are bottling companies in other parts of the world. Think about that. Why do you think Coca-Cola would want to be able to influence operations at those businesses? If you're Coca-Cola, what do? You manufacture the syrup for the soda, but the consumer typically doesn't buy the syrup. The consumer buys the bottled drinks at the grocery store. So without a distribution channel, Coca-Cola will have a hard time profiting off of its product. So what do? They buy significant stakes in the companies around the world that do their product distribution, so that they know that they will always have someone to package and deliver their product. You'll note that most of these are described as being equity method investments. That means they're not reported at fair value, the way that marketable securities in the current asset section are. Now, if these are shares of stock, why do they think they weren't included in the current asset section above? Well, there are two reasons. First, what is a current asset? Something that will be converted to cash within 1 year or one operating cycle. Do you think these investments are going to be sold at any time in the near future? Of course not. These are strategic investments, like buying a warehouse or a factory. Second, these represent significant blocks of shares, between 20 and 50% of the outstanding voting share of each of those companies. Let's say for a moment that we wanted to sell them. What do you think would happen to the shares of those companies if we suddenly flooded the market with them? Price would likely plummet, don't you think? So those are considered long-term assets rather than current assets. So then we see the other things they've got on their asset side. Other assets, our property, plant, and equipment. That's our factories, our trucks, and the like, and our trademarks with indefinite lives. We'll talk more about this in a later chapter, but our assets don't need to be tangible. Recall the definition of an asset: a probable future economic benefit that results from a past transaction. So let's say I buy Fanta. When I buy that company, I'm not just getting its stuff, but I'm also buying its brand name, its cachet. People will buy my product because of name recognition. So that trade name fits the definition of an asset, even though we can't physically touch it. So we're going to call that an asset on the balance sheet. It's interesting to note that the value of Coca-Cola as a trademark doesn't show on the balance sheet. An asset has to have had a past transaction associated with it, such as buying Fanta. But if we have developed that trademark internally over time, there's no transaction we can point to with a dollar figure attached, so we ignore it on the financial statements. Those other intangibles, those would be other similar items, non-compete agreements, patents, customer lists, things we would have paid for that provide future economic benefit. Goodwill is a reasonably complicated topic, so we'll defer that until we get to that particular chapter in the text. So there we have our total assets, our stuff. Now, who has claims on this stuff? Those are the liabilities and the equity. Again, we have our liabilities broken out into current and non-current, and we get a subtotal for the current section: accounts payable and accrued expenses. Here's what we owe our suppliers, our employees, and the like. Loans and notes payable, our short-term borrowings from the bank or issuances on the bond market. Our current maturities of long-term debt. Let's say we borrow $100 million to build a new factory. It's possible the bank isn't going to want to wait 10 years to find out if they're going to get repaid. Rather, they'll make us pay a bit back at a time, perhaps $20 million a year over 5 years. If this is the case, the portion that we will need to pay in the coming year is included in the current liability section, with the remainder outstanding living down in the non-current liabilities. And so we can compare our current assets to our current liabilities, so we can do what? Make an assessment of solvency. Current assets divided by current liabilities is called the current ratio. Do we expect to have sufficient cash coming in to satisfy the liabilities that need to be paid in the coming year? As things stand, the current ratio is less than 1. We've got 8.4 over 8.8. That's less than 1. And that's not particularly ideal. That means that our current obligations exceed our current assets. Now, of course, a goodly bit of that current asset up here is in the form of inventory, and that doesn't include the profit margin that we're going to earn on those sales. But even so, having a current ratio greater than 1 is desirable. If this ratio were very low, we would begin to wonder about bankruptcy risk. And then we go back and revisit that going concern assumption. We have our long-term liabilities, Those debts we're going to have to pay off sometime after the next year. And then we get into our equity section. Owner's equity, shareholders' equity, stockholders' equity, what we call it doesn't really matter for the most part. This is the residual that belongs to the owners of the firm. We see common stock and capital surplus right here. Together, these make up the money that's been directly invested in the business by shareholders. This is followed by reinvested earnings, right there. Most companies refer to this as retained earnings, but I really like Coca-Cola's name for it. This number represents all the profits that the firm has generated since it was formed, less any dividends it has paid the shareholders. Does that mean that they have $33 billion in cash lying around? No. If you see, we've actually only got $2.4 billion in cash up in the asset section. This money has been reinvested in the business. Where has it gone? It's gone into property, and it's gone into investments. Okay, so retained earnings doesn't represent cash that we've got available. It simply represents the net profits that we've earned over time. The next item is accumulated other comprehensive income or loss, right down here. If you recall, I said that I didn't like the statement in the book that the statement of shareholder equity is least useful, and here's why. In 2006, Coca-Cola had $1.2 billion of lost shareholder value that didn't flow through the income statement. Foreign currency losses, hedging losses, losses on some short-term investments, and the like. It's a true loss of shareholder wealth, which is why it acts as a negative to shareholder equity, but it never showed up on the income statement. If you were to look at the statement of stockholders' equity, it will provide a reconciliation from last year's $1.67 billion to the current amount that they are down now. Lastly is treasury stock, which represents shares of stock the firm has repurchased on the open market. Again, we'll defer that into a future chapter when we can spend some more time discussing that explicitly. So there we have our total liabilities and total shareholders' equity, which, you will note, exactly equals the total assets above. Again, we need to maintain this balance from both a mathematical perspective, the equation needs to balance, and a theoretical perspective. All the assets are claimed by someone. Either the creditors, our liabilities, or the owners, who gets what's left. One last item on the balance sheet. You'll see the footnote right down here that says, refer to notes to consolidated financial statements. That is, of course, where all the nitty-gritty is found, and we should be able to find explanations for most of the numbers on the balance sheet. Never fail to examine the notes, since those are what put the tabular statements into context. Phew, the balance sheet. So next we turn to the income statement, and there is this great quote with which I like to start all of my income statement discussions. What is set out as a measure of net income can never be supposed to be a fact in any sense at all, except that it is the figure that results when the accountant has finished applying the procedures which he adopts. It's quite a mouthful, and I guess that's the way they spoke back in 1929. If we were going to modernize it, though, we could pretty much say this, that this is this. Income is not a fact. It's not a fact in any sense, except it's what we accountants say it is. We made up the rules, and if we follow those rules, we get to a number called net income. I have followed those rules, and therefore this is net income. And because I play Dungeons & Dragons, what I say to that is, huzzah! I like this quote at the beginning of the semester, because it's actually pretty true. And this reinforces what we did in the last class, when we were trying to make a decision between Firm 1 and Firm 2. We see a number called net income, but that number is completely meaningless out of context. And we can make some horrible decisions if we try to use it that way. Income is not a fact. Accounting is flawed. There are some huge drive-a-truck-through holes in our accounting system. But there are some places where intuition fails and internal consistency fails. It's not ideal, but we have to live with it. And living with it means that we need to understand those inconsistencies. Understand those places where someone can manipulate the results. Learning how to live with them. Having said that, my little off-the-cuff equation isn't actually true. We know from extensive research that net income is used by financial statement users in a predictable way and in a consistent way. Think back to your statistics class and the concept of the linear regression. Y is equal to alpha plus beta x plus epsilon. If we make Y our stock price or stock returns, the best X we've got is net income. If we make next year's cash flows our Y, net income is the best X we've got. Pretty much any measure of firm performance that we can think of, if we want to explain it using regression analysis, net income is the best X we've got. So net income is pretty good. Flawed, but pretty good. The trick is learning how to use it, and the smart people have done just that. Here's an example: research and development costs. Due to conservatism, there's no such thing as a research and development asset. As we spend money on R&D, we charge that to expense immediately. Now, matching tells us that if we expect future revenues to be generated from a cost, we should capitalize that cost and expense it in the future when we generate those revenues. So what is this implicitly saying? It's saying that R&D expenditures have no impact on future revenues. This is, of course, a preposterous claim for a number of reasons. First and foremost is that people continue to spend money on R&D. And if year after year it was just squandering money, people would have stopped. But also, in the big picture, R&D must add value, because if it didn't, we'd still be living in caves hitting each other with clubs. Development of new technologies is clearly value added. The accountants, however, say that there's no guarantee that any particular R&D project will bear fruit. And that is true. Out of 10,000 compounds a drug company might identify, only one typically ends up making it through human trials and being marketable. So because of this risk, we have said better safe than sorry, expense it all right now. But we know that these large tech firms spend gobs of money pursuing various projects, and they consistently bring new products to market. So we see in the accounting system a complete discounting of these expenditures, even though we know on average that they are value added. So what has the market done? It treats those expenditures like an asset. Back to the regression. Let's say that prices are Y and we've got a couple of X's. So we're going to decompose this into net book value. So the net assets, total assets minus total liabilities, plus net income. But so what people have done is that they have taken the R&D expense and added it back here, and we've created an R&D asset and added it in here. And when we run our regression like this, we discover that our R&D expenditures are indeed treated like an asset, not like an expense. They're treated the same way as if we purchased a truck or a building or another company or something like that. And we see that the market also treats it differently. If it's a pharmaceutical firm, which might get 7 years of value out of a patent once it's gone through human trials, versus a computer hardware manufacturer, in which after 2 or 3 years the technology is obsolete and a new product must be brought to market. So while there's some flaws in the accounting system, people who know how to fix those flaws can use it to make good judgments and good decisions. So, when do we recognize revenues? Well, when earned, right? Earned and collectible. And expenses are recognized to match with revenues. We already did that. Capital expenditures, though, when we buy a major new asset, that's new. But you know what? It really isn't, because we're still matching. Let's say we buy a truck today and we're going to drive it for 5 years. We write the check today, but when is the revenue being earned? Over the next 5 years, right? So what we do is we take that expenditure and we turn it into an asset and then allocate that cost over to the income statement as an expense. And we'll call that depreciation expense. And we allocate it over that 5-year window. It's still matching, but over a longer period than when we bought that inventory. Now let's take a look at an income statement. I've reproduced Lucent's income statement from 2002 in your notes packet. Again, there are descriptions of key terms in the notes, but for purposes of this lecture, we'll just look at the actual income statement. Again, we see that these are consolidated financial statements, and there are now 3 years of data instead of 2. This allows us to better identify trends and relationships between the numbers. Their fiscal year end is September 30th, because that's what they wanted it to be. The income statement is for the period ended. This is a flow statement that covers a period of time. In this case, November 1st to September 30th, as opposed to the balance sheet, which is an as of date. We see over here revenues, both product revenues and service revenues, since Lucent provides both, minus the cost of goods and the cost of services, and that allows us to get to our gross margin, our first subtotal. They sold a total of $9.6 billion of stuff, which cost them a little bit more than $8.4 billion to produce or buy. They provided $2.7 billion of services, which cost them $2.3 billion to provide. So now we see how their pricing relates to the cost of their actual products. And why do we break this out? Because it's useful information that can help us make decisions. This is followed by our operating expenses. Here are the other costs that we needed to incur to run the business that weren't directly related to the production of the goods or the provision of services. These are all of our back office activities: the CEO's salary, advertising costs, sales commissions, R&D, and the like. Look, there's our R&D, $2.3 billion in a single year. This is also where we can see the ability to control costs. Perhaps our margin is fixed. We do a lot of government contracts that are on a flat cost plus profit basis. In that case, our ability to make ourselves more efficient are all down in the back office activities. So we've got those broken out. This brings us to another subtotal, operating income or loss. Essentially, here's the wealth we created or destroyed by running the business on a day-to-day basis. How did we do doing the things that we do? This is followed by non-operating items, in this case, interest expense. We have this pulled out separately for the sake of comparability. Let's say we have two companies, Daveco and Bobco, which both do the same thing. Daveco borrowed money to start the business, and Bobco issued shares of stock. Daveco is going to have interest expense, whereas Bobco isn't. And while we don't want to give Daveco a pass, the interest really is an expense and belongs on the income statement. It isn't relevant to the question of how Dave is running his business as compared to Bob. This way we can look at the performance of the two businesses and make a better decision regarding management performance. So we've got our income from continuing operations, we subtract out our taxes, and then we have a line for discontinued operations. Why would we pull these out? Because part of what we want the income statement to do is to provide predictive ability for future earnings. And if we just sold off a division, what impact will that division have on our earnings next year? None, right? It's gone. It's someone else's pig now. So we've got that pulled out separately, again for the sake of making better decisions. We have an extraordinary gain in here. For an item to be extraordinary, it must be both unusual and infrequent. A hurricane in Florida is neither. A hurricane in North Dakota is both. These are again pulled out because they have no predictive ability for future performance by definition. It was a fluke, a complete surprise. And we never expect to have another hurricane in North Dakota. So let's pull it out to make prediction of next year's income easier. We've got the cumulative effect of changes in accounting. We can't change our accounting policies to fudge the books. Or rather, we can, but it won't work. Why? Because if we change a policy, we have to disclose it. We have to explain why we decided to do so, and we have to go back in time and pretend we'd used that method all along and plug that cumulative effect into the income statement in one fell swoop. So it's completely obvious and won't fool anyone. And that now gives us our net income. Net income to common shareholders. We also have it broken down into earnings per share down here on the bottom. Why? Well, because nobody owns Lucent. They own shares of Lucent, 100 shares, 1,000 shares. Some poor sap has probably got a couple of million shares. So if you're looking at the income statement and you say, golly, they lost almost $12 billion in 2002, I have absolutely no concept of what that means to me as an individual. I know it sucks, but that's pretty much it. What I do know is that I bought my 100 shares at $50 a share, and that per share earnings or loss tells me what I got for my investment. That puts that performance better into context for me and makes it easier for me to decide whether to hold or to sell, and if I'm going to sell, at what price. You'll note that there are two different types of earnings per share, basic and diluted. We'll come back to this, but the upshot is that there are securities that aren't common stock, but could become common stock in the future. Convertible bonds, stock options, that sort of thing. While basic earnings per share is based on the shares that are actually outstanding, diluted asks, what if everyone who has a reason to exercise their right to shares did so? Now what would earnings per share be? It's basically a worst case scenario for earnings per share. Once again, they say look at the notes to the footnotes, or to look to the notes to the financial statements down here on the bottom. That's always good advice. So there's our balance sheet and our income statement from the 10,000-foot view. There's a lot of information, and I certainly don't expect you to have internalized it all. We'll be going back through both of these statements bit by bit as we work through the next 6 chapters or so. But it's nice to get a little perspective as to why we care about all those little details. We'll also look at the cash flow statement in its own chapter and the statement of shareholders' equity when we talk about equity in greater detail. Next chapter will be the accounting system and the double entry bookkeeping system.